Hello, everyone. Thanks for attending today. And after the product demos on embedded finance, I think we can go deeper into it. And I have all the right experts. So uh, I think everybody can introduce themselves and also talk about the evolution of embedded finance. I think in the early days, we were happy to first integrate payments into it, and we were happy that commerce flow mein payment aa gaya hai, and that was like a big win. Then we started adding insurance, we started adding BNPL credit, credit card credit. All these things have happened along a long journey, and it has happened across the board. And we have experts from across the field. So we have Ashish who will talk about it from the consumer lens, Rakesh from the MSME lens, Sumoth from the bank lens, and Lavin from the infra lens. And as we get all these perspectives, we'll go into different areas that have to work together to make embedded finance successful. So over to you guys with introductions and how you've seen these journeys.
Hi, my name is Ashish Goyal. I'm co-founder of Five. Earlier it was known as Early Salary. I still can't go without saying Early Salary. So we started about 10 years back with a purpose saying that there is a large middle India and how can we service them. Both as a consumption loans where the money goes to the customer's account. But over last 4 years, we also built a large embedded finance book purely because we realized that if we really want to build a large franchise, large distribution models, embedded finance is the way to go. And today, embedded finance is just not about like what Sayali was saying about credit cards, like where the credit cards are embedded into the as a payments option, but they are embedded into the mobile application which Bajaj did for last 10 years, where the mobile financing, consumer durables has become like one can't think of taking a mobile phone and not figuring out saying that it is available on zero cost. But now it has gone to the next level where education, healthcare, travel, whether we talk about e-com financing, where we either it can be pay letters, which we see as postpaid, or it can be creating affordability. So in my mind, embedded finance is now becoming a very, very big tool for the merchants from the perspective of creating affordability, purely because not each product can be bought by paying upfront. And taking a personal loan for it is a break-on journey. How can you really be buying a product while ensuring that the merchant himself is ensuring that there is a credit available if you are a credit-worthy customers? And the kind of places where now we are seeing that kind of adoption is really fascinating. Like today, schools fees is becoming one of the channels where you can actually pay your school fees into EMIs. Similarly, healthcare, hospitals at the place where one can't think of saying that hospitals will think of saying that okay, I'll get you a EMI option available at the hospital doors. We are seeing that kind of conversation happening. Travel has become another category, like rooftop solars. Earlier, rooftop solars, you go to a bank, get a loan approved, and then do the process like a project management. Now it's just become a consumer durable. It's embedded into the journeys of a sales by a rooftop solar guy. So more and more, everything which was happening as a EPC, let's say somebody where the people were buying the credit separately and the product separately, now the manufacturer himself is trying to figure out how can I really embed it, because there is an opportunity to upsell, there is an opportunity to convert it. And also, affordability in this today's generation has become really, really super important. And there is a big difference. What we really look into is affordability versus convenience. In our mind, credit card is a convenience product. आप जाते हैं, credit card swipe करते हैं, 60% people just pays on the month end by themselves. And some people who don't pay, that becomes a credit for them. Whereas when we do the embedded finance, it's actually affordability. We take a 50,000 rupee product, we convert them into 8,000 rupee EMIs. The interest may be paid by as a subvention by the merchant or by the customer, depending upon what kind of things which we are doing, what kind of margin the partner runs it. But here we really create affordability. The credit cards don't create affordability. They are more of a payments instrument. So there's a big difference, and that's where we have a firm belief that when you do embedded finance, it's not a payment options, it's largely a credit options. If it's for affordability, if it's a convenience product like postpaid, the lazy pay or the credit cards, that's our convenience products. So, and I think day by day, each and every thing in the customer's life will become very embedded finance will be a part of it.
Thanks, Ashish. And I think in my journey in Patience, we saw the same thing, like starting with affordability was key to where the customer is in commerce. But I think the MSME journey has been quite different, where proving the entire value chain and all the players in it and where they come from, along with the governance, is another level harder. And Rakesh ji, if you can talk about the evolution of that.
Okay, so glad to speak to all of you. My name is Rakesh Bhatt. I'm 32 years in the industry, a financial services veteran, and still a software programmer by heart. So run a small software company also. Embedded credit, okay, we just saw a demo, right? There are so many buzzwords out there. But traditionally, if I trace back myself, Sayali, okay, 1998, okay, I saw a bunch of invoices coming to a branch and somebody entering into Excel. And I say, hey guys, what are you guys doing? Well, okay, we have launched a new product called invoice discounting. Fast forward, okay, the year was around 2009-10. I was part of a financial services group, which was belonging to the largest OEM of the country, two-wheeler, right? And again, I was a technology head and operations head there. And then they said that we want to do purchase order financing. I said, what are you talking? Okay, where is the system? But we had got our own traditional system, right? And the purchase orders, but the way it used to happen, Sayali, was the CFO of the OEM will qualify the suppliers. Okay, they might be having some 1,000 suppliers, but he will qualify 200 suppliers. And, okay, and then basically for the 200 suppliers, the purchase order will come. And we have got our own traditional system. It will get punched in out there. So short tenor, okay, approximately 3 to 4 month fast running tenors, right? A good business. Okay, the NPA also doesn't happen, right? And then the world moved ahead. Okay, 2015 happened. We had a beautiful product. Okay, a LAB BNPL before McKinsey popularized, right? Okay, it was called EMI card. And Flipkart, and because we were selling at merchant point of sale. By your definition, you'll say, no, that's not embedded credit. Okay, accepted, right? Fine. So Flipkart came, Amazon came. They said that, oh, we are going to sell your mobile phone in the same way you are selling at Vijay Sales, right? But we want to deliver the customer experience. Yes. I said, what is the meaning of customer experience? We want the decision there and there. So fast forward, okay, the point I'm trying to say is, let's have an analogy. There is a pond and there is a horse. Pond is the lending institution. Horse is where the action is or the customer is. For many years, the horse was going to come to the pond. Yeah. And they still do. Okay, but this horse has got smart. It is no more going to come to the pond. Okay, he said that the pond should come to me. Okay, fine, the pond should go there. The fundamental thing is the lender is going to go, okay, to the horse or the arena of the horse. Fundamentals of risk management should not be lost. I have to lift and shift my credit, okay, in the same way as if the horse had come to my pond. I have to lift and shift and embed it, okay, into where the horse action is. Yes. So that's why I say that the word is about embed and credit, okay, the caution to the wind has not to be thrown. MSME is a huge, okay, marketplace out there. There are 3 kinds of categories. Okay, one are highly organized, can have a digital footprint. Second is basically semi-organized. And third is what India wants to do. That means unorganized as well as the large footprint guys. I don't know how we are going to solve for that. Okay, but we'll learn from the banker next to me on his experience and they'll come back to risk.
Yeah, thanks Rakesh ji. And I think that's what is going on. The horse is on the mobile and that's where the customer is. So the platforms, the e-commerce platforms, travel platforms, all of them are owning the customer experience. But the onus of risk, compliance, all of that is still on the banks. And while catering to the very, very demanding native experiences that these platforms want. So how have you seen this evolution from what the end consumer wants and what the bank needs to do to not throw caution to the wind?
Yeah, thanks, Sayali. Good afternoon, everyone. Myself, Sumoth. I head the fintech partnerships in Federal Bank. So we tie up with fintechs to create one more sourcing channel for the bank through the front end will be done by the fintechs and the back end underwriting will be done by the bank. So to start with, as I want to, maybe there's a misconception among all that embedded finance or embedded credit is a redirection journey. It's not that. It's not a redirection journey which we call it embedded finance. So as Rakesh was telling, how earlier the horse was going to the pond, now the pond is going to horse us. Right now as bankers, we want to be present where the customer do some transactions Not thinking of, because we normally don't wake up in the morning, okay, today I will take a loan. It's not happening like that. So even bankers, we may think of finance, but normally customer doesn't think, I want to take a loan today, waking up in the morning. So normally when he does a transaction, how can we present in that particular point of purchase and offer something for the customer so that he sees that particular offer and say, okay, this is a good option for me to club my finance needs with that particular product or with particular service. So that's where the embedded finance comes. As I earlier mentioned, we started with the redirection journeys. Then there's an embedded APIs which came into place, which helped all the embedded finance or embedded payment journey. Then right now we are talking about SDKs, because morning I was attending a roundtable where the topic was DPDP in the context of co-branded credit cards. So when you talk about the security side, maybe we'll come later also. This is very, very important, because in an embedded journey, there can be confusion who owns the customer. Whether the merchant or the partner owns the customer, or whether the bank as a financial institution owns the customer. So this dilemma is always there. So how you technically design the journeys to ensure that, I'm talking from the context of DPDP also, I just want to bring that subject also here. How the data resides with the financial institution on the payment data or the lending data, but other consumer product data remains with the partner. So that's very critical in designing the journeys. So I just want to highlight those. So going forward, anyway, this will get more critical once the DPDP law comes into the force with all the DPDP board, everything is coming. So the creating these embedded journeys is how to create these embedded is very, very critical, where customer doesn't feel the difference between the one where he started the transaction and where he ends up with availing a purchase. So the designing and the data protection is very important in creating the journey. So that's the journey which we are all in. So that's I want to.
Thanks, Sumoth. This brings us to you, Lavin. And while the platforms and the lenders figure out customer kiska hai and who owns what risk, I think a massive amount of responsibility lies with the infra layers. I mean, not just being the peacemakers, but actually connecting the dots, making sure the compliances are also held, the data is also protected, and yes, the best possible customer experience is delivered at the point of consumption. So what has this role evolved? How have you seen it happen over the years? And please talk about that.
Hi, good afternoon, everybody. I'm CTO and co-founder of Transbank. We are an open finance infrastructure company. See, essentially, I'll break embedded finance. Being a tech person, I'll probably treat it more like a system problem or a workflow problem. So I see it as three different rails, right? The two rails are typically what people normally are aware of. One part is the transaction rail. That's the point of transaction, right? It could be the transaction, could be a B2B transaction, or it could be a B2C transaction. Historically, and then there's the finance part of it, where you're actually getting the credit decisioning or other elements coming into picture. And historically, what's happened, what the journey is, when I started working my career as a ERP consultant, I saw the transactions and the finance were divorced flows, right? They were two different flows. So somebody entered transactions in a particular system, and then the financial journey used to be a separate journey, and then it was all about making them come together. So embedded finance started off with probably a payment journey, then evolved into more about where you try to make finance and the entire process end-to-end. To this third part, what we have seen an evolution coming into picture is, especially when you're looking at scalability, when you're looking at risk aspect, is where it's not enough to just have the aspect where you have the transaction, you embed the finance part, but there's a third important part where we've seen and we are focusing a lot, which is the control part. This is the part where reconciliation happens, right? Because without, you could give a fantastic journey to the customer, give him the credit what he requires, but at the end of the day, it's the whole lending business is a confidence business, right? At the end of the day, you might start off with a big bang, but if your reconciliation, your risk processes are not in place, that's why we feel reconciliation also plays a major role to make sure that is the money that being lent out, for example, if you take the example of invoice discounting, right? Are they being reconciled in terms of maybe, are they being entered into the GST system? Are they being entered, is the money coming back? So these are all the rails that we have seen the evolution now happening. So it's not just linking transaction to the credit journeys, but also trying to bring an element of reconciliation into it.
Yeah. Thanks, Lavin. And maybe all of us can talk about this process complexity, right? And the process is like where the platform will say, मुझे KYC वाले lenders नहीं चाहिए. And the lender will say, मुझे, visit भी चाहिए, interview भी चाहिए, everything चाहिए. So when everybody is at ends of spectrum and the ways to compete could be very different, whether you're competing on risk or on process on this, but it all comes together. So can we talk about process and how it's also evolving with data privacy law, with compliance laws, with co-lending laws, KYC laws, and CKYC also? While all that is going on, how is these processes evolving across the board? So anyone, please take it up.
Yeah. At least there is a promise of a brilliant process being there because of evolution of technology. Okay. But if we say a couple of things, I'll come back to the process. Let's talk, Sayali, for us about the product. Okay. Typically, a high-end MSME, we will have a P&L balance sheet cash flow program, eligibility program. Okay. Then we might have an ITR program. We'll have an average bank balance program, and we might have a GSTR program. Right. So the lender first has to curate, okay, what kind of a program, okay, they want to offer, the eligibility program. Because what is the evidence, okay, in the process part of the technology enabling, I might be I might be having visibility of the purchase orders, the trend with respect to the cash flows, the payments which are happening to that merchant. Okay, so there is a curated new program which will get created specifically because you are having real life evidence, okay, of the transactions he is making with the supplier is making, right? The challenge which is going to happen is, as you rightly said, will I be able to do PD? No. So the intent part of it, okay, the intent part of it is we should not spoil the process just because I'm not having visibility with respect to the intent part of it, ability to repay. I got very good evidence with respect to why it should lend, okay, basis what the event is happening. Okay, so that's one part of the process. Okay, the second part of the process is what Lavin was highlighting it, completing it end to end, right? I should have visibility post the transaction also. There I will put all my eggs into basket because traditionally I'm a technology guy and technology will solve for it. So a good product offering, process enabled by technology, okay, it should be visibility end to end, okay, which has to be there. But then, does the risk get fully solved? I'm not totally clear on that part.
So it's a chicken and egg. Merchant always want the best approvals. They want no KYC. They want no rejections. They want the lowest subvention rates, etc. And as a lender, you run a 2% business because it's a very, very tight spread businesses. And on the top, you are a highly regulated environment, rightly so. So you need to do KYCs, you need to do everything. But, then your sales teams keeps coming saying that XYZ lender is doing this thing. So they keep saying that this is the best market practice, and I keep saying that this is not best, this is worst market practices. You are asking me to adopt that worst market practices. So it's always a fight towards managing the merchant experiences while ensuring that you do it. There are 2-3 things what I believe when you do an embedded finance. The first embedded concept is that we have worked with merchants where they keep coming back in the initial days telling us that X is doing this, you are not doing this, I am losing sales. But 6 months, 12 months down the line, it's a persistence business, perseverance businesses. You need to keep saying that, look, as they scale, they will also come back with the same challenges. And when they come back with the same challenges, they will not able to deliver what we deliver because we already has built the systems around it. We know how to do the VKYC faster. We know how to do the approvals faster, and we have not taken those shortcuts. And it's a process, and there will always be, there is somebody who is ready to lose. There is some loss leader which is always there in the market. So you need to just be there and handle that piece. But having said that, today the embedded finance also brought a lot of information, like underwriting NTC using the merchant data. Like just to take an example, like we keep hearing which merchant he's going to, which branch he goes to, what kind of product he's taking, what kind of course he's taking, what are the, let's say if somebody is going to an MBA institute where there is a entrance exam, and he passed that entrance exam, does it qualifies him to take that loan without a securities? How do you really go and break those traditional shackles, saying that, okay, I'll lend on certain alternate data which is available, which is not the alternate data which we keep saying that, अच्छा मुझे utility का data दे दो, मुझे telecom का data दे दो. I'm talking the alternate data with the merchant which we are working with, which is he's saying that, look, work through my process. Let's say just take an example of insurance. If the insurance underwriting has been done, the customer has gone through the medicals, etc., that itself is a big friction. You want to create a frictionless journeys to onboard him. But how much friction the original product has, that itself can be underwriting. So idea is that all those things, as we go on building embedded financing, it also will open up a lot of opportunities for people to really deeply understand the merchants, do work with them, like whether the particular center is in the suburbs or in the top tier shopping mall, that can also be underwriting principles. So all those things will define how you are going to maintain your merchant relationships. At the end, my belief is when you are doing an embedded finance, your customer is your merchant. The customer is your risk. The merchant is to be satisfied saying that he is happy with you. And that will become very, very critical for you to keep working with him, keep ensuring him that whether it is support, whether it is underwriting, whether it is collections, everything you need to work on it with them. And like when we started embedded finance at our end, today we are actually running two companies, one where we give personal loans or the consumption loans, and the second where we do embedded finance, and because both of them are very, very different. So I think it's a mindset. If somebody is building embedded finance, it's just not anything, and that's where the people with very, very focused approaches, especially the NBFCs, because उनका एक ही काम है, पैसा देना है, वापस लेना है, और कुछ काम नहीं है हमारा. So from that perspective, it becomes very, very easy to be there to build those models, build those rails, build those APIs, build those understanding.
Sumoth, maybe I'll ask you, as these NBFCs move fast to partner with all the partners, how have banks evolved? Because it's been harder for the banks to let go of so many processes and evolve in a different way. And Federal is one of those who have partnered with so many. There is a reason why all the fintech founders are on a pilgrimage to Kochi all the time. So please tell us about how you guys have moved so swiftly to address the needs of these platforms.
So I'll take from what Ashish was telling. See, we bankers always have a bad reputation in the market that we are so stringent about the processes. But as a regulated entity, we don't have any choice. But process experience, we are seeing, especially as a bank, Federal Bank, which is well-versed in the fintech partnerships area, we are not seeing process or experience as either or. It's and. How we can embed the experience with the regulated processes, as I earlier mentioned, so that customer experience is seamless. So embedded finance always helps in that. Where maybe I can tell you that some earlier, Rakesh was telling about horse and pond. I want to make a simile on the partnerships like a racecourse track, where I see the fintechs or the fintech partners are designers who design the vehicles or the cars, and maybe the regulators create the racetrack with the boundaries and the path, and we bankers are in the driving seat with the customer as a co-passenger. Nice. So where all the what you say check boxes are ticked, where of course the customer experience is ensured by the partners, because when the partnership we make it upfront very clear to the partners where we partner with, that the roles and responsibilities and the boundaries are very clear. The customer experience or how you create the onboarding journeys, we left to the partners, of course. That is their prerogative, and that's why as bankers we partner with them. Because
when the regulation
I don't have any shame in saying that we bankers are poor designers, in a way maybe. But that choice we left to the partners. But all the compliance, regulations, whether it is underwriting, policies, collections, grievance redressal, that's very important. Grievance redressal. That and all it's a banker's responsibility. So if the roles and responsibilities are clearly drawn, there's no confusion between the partnerships. So that's how the philosophy in which we are working. So process naturally, once that broad line is clear, there is no confusion about the process or the complexity of the processes. But of course, as I earlier mentioned, how we can seamlessly embed those processes into the journeys, whether it is onboarding or whether it is KYC or whether it is VKYC. Even the regulations of late, a lot of regulation clarity we got, especially when after the digital lending guidelines or the guidelines on co-branding credit cards. So a lot of clarity is there. It helps in the industry, whether for the bankers or for the partners. They know what the industry or the compliance requirements, regulatory requirements is there. So there's no doubt. But of course, customer experience we always keep first in mind to create these journeys, embedded the process in there. So customer doesn't feel that, of course, I am moving from maybe an easy journey to a complicated journey for a banker's journey. So the thin line of difference we try to avoid. So that's how we create the processes.
Right, I think, and everybody's gotten good. Key regulations are changed, call the cars to the pit stop, change the tires, and then go again, right?
And of course, the regulations are also now fast changing, very easily changing. So this embedded journeys or creating the journeys within the system is very easy because already if the bank has the framework already in place, tweaking the journeys within the journey is very simple, very easy to create the journeys.
And that's where I think platforms come in, Lavin, and I would love for you to talk about process and product innovation that you guys are driving to make these journeys better and flexible so that it can evolve with regulation faster and you don't have to be in the pit stop forever. So we'd love for you to talk about that.
Absolutely. I think we, as an open finance infrastructure setup, actually we started our journey more from a perspective of integrating with banks. So a lot of the regulations that were applicable to bank, even though we are not technically a registered entity, were something which we went through as a journey. So we went through PCI DSS, SOC 2. So we had to bake that as part of our early journey or as part of our ethos. Second aspect is because at the same time we had to be mindful of the fact that we cannot be slowing down the customer, because at the end of the day, it's also about customer experiences. So there was a fair amount of what you call discussions or where can we try to improve the journey? Can we put in more APIs, or can I bring in more APIs which will give that confidence to the bank that, oh, we are doing an initial check before even the data is hitting you, right? These are the kind of journeys that we have gone through. To add to it, we've also started working with mutual funds, insurance companies. So that gave a totally different perspective. So while banks have their own sets of regulations, we discovered that financial institutions also made sure that before I put a solution in front of them, it's vetted completely. So for us, the challenge has always been to be within the range of regulation, whether it is on the banking side, on the mutual fund side, but make the system configurable, make it easy to implement. These are all the challenges that we've been working with, and we have tried to build an ecosystem of APIs which could help us do that. That's been a journey.
I think one thought I keep having is the risk that comes with all of this and how we are all managing it, right? One of it is portfolio. How do you balance your other loans portfolio while growing your embedded book? And within the embedded book itself, how do you manage the richness of data? Because all the data that you're getting from, say, platform 1 is also enabling you to give a loan to that same customer on a platform 2. But there is also risk from the data, not just complying with the DPDP law, but actually holding customers' very deep lifestyle and economic and financial data. So how are you looking at risk from a portfolio, but also from a data perspective?
Okay, so we as lenders have been doing this. An example can be in a good running portfolio. Also, what we do is a design of experiments, right? You launch risk DOEs and you see the track and performance of it. So, of course, there will be an opportunity to do that also. I was just basically talking to a education finance company, okay, and they created a brilliant product, which is like, okay, schools, but with 1 lakh rupee plus fees kind of thing. Okay, beautiful ERP, and they created a 2,000 crore portfolio. Your portfolio question is there. Drilled down to 1,500, okay, but doing extremely well, 0 NPA. Right. The question is now, how do we take it further ahead? No, sir, वहाँ पर ERP नहीं है. Okay, now you see, my problem is, there are thousands of schools which are there. They are not going to have this kind of a thing. The working capital the school requires, it's a beautiful product. The students, of course, are going to give the fees. right? If the ERP is there, then we are saying only the organized MSME guys are going to get this. What about the samosa wala, which is there, okay, ahead of us? Lavin's, okay, wire will not go there. Okay, sir's bank line will not go there, and Ashish's company will not go there. So I'm trying to say that 10 years down the line, okay, if this portfolio has to become huge, is it only a tier 1 product? Okay, is it only a certain segment of consumers or MSMEs or anchor clients or the dealers or the merchants are the only people who are going to enjoy it? So I see that from a portfolio perspective, okay, the possibilities, like, okay, it's an urban product. Will I have a rural business getting created out of this? Then the enormity of this particular product is definitely there. But if you go from a pure technology perspective, that there is only technology only which can solve, my wire has to go all the way there, then I think, okay, we might have to wait for a few years. But the fact is, the pond has to go to the horse. Okay, the lenders' channels are, I'm not saying they're going to go dried up. They better embrace this change. Okay, they better change the processes, launch products, design experiments, okay, create a good portfolio, because this is a amazing opportunity with the possibilities which are there. And we've got an amazing regulator. It's the most prudent regulator on this side of the world, right? They are, of course, going to, of course, you cannot have a compliance where KYC nahi karunga, onboarding nahi karunga, ye karunga. You see, there are fundamentals of lending. It's a business which you are in, you have to do ABC, right? But will the regulator, after a couple of years, see this massive change which is happening in the industry? They'll curate some guidelines. I believe, okay, they will do it because they are quite prudent and they know that. Because their aim is consumer. Regulator doesn't love lenders, okay, bankers. They are interested in the consumer. And with respect to the way the government is also an MSME, okay, industry or the department or the finance ministry also sees it, right? How does this kind of a benefit go to the last mile, okay, on the MSME side? I think the government will also do something more. In fact, government is doing more. The treads and vehicles, they are all, okay, government initiated. So I think the government is moving fast. Regulator is prudent. We have got great technology platforms. I think my two friends on the two sides, okay, using right platforms technology, they should be starting lending, okay, at a great way. Thank you.
Thanks, Rakesh. Anyone want to add to the risk aspect?
Just want to add on the, especially on the data side, as taken from my earlier example of the risk scores. As a driver, it's my responsibility to see that my co-passenger reaches the destination without any accident. So the protection of that customer's data is all the more important as a regulator entity for me. So we created certain journeys, especially with the travel partner for a co-branded credit cards, where regulations are very clear that the co-branding partner should not have visibility on the data. So we created some SDK inside the particular app, where all the lending or the card journeys happen within that SDK, where the partner is not having visibility. But of course, the customer has get all the experience, but the data resides with the bank without any data going outside to anybody. But the customer can do all the transactions, complete the journeys, with the customer experience given by the partner. So the data resides with them, but that's I just wanted to highlight. And whenever we talk about embedded finance, the first product which comes to mind is BNPL. Yes. And similar to that, we created a product called TNPL. It's nothing but travel now, pay later. So as soon as you book a ticket, immediately you can convert that into an EMI or as a personal loan. So again, this happens within the journey, within the ticket booking or the journey itself, can convert that into a, but of course all the data remains with the financial institution without any data going outside. I just want to add this.
So as an infra player, what we do is we act as, in certain cases, purely as a gateway. In certain cases, we act as custodians of data also, but we make sure that, because at the end of the day, it is either data which belongs primarily to the customer, right? And also to the corresponding lending, or it could be a mutual fund institution. So we work on various models. So one part is where we have data privacy coming into picture, where data has to be stored very effectively, follow all the norms. We try to give the confidence to our customers. But then we also have models where the customer feels that because he owns the data, he thinks there's a fiduciary, I mean, obviously he has the fiduciary responsibility of safeguarding the customer, right? So we have worked on models where we also allow the customer to have his own data source. It goes through our rails, but we don't store the data. So these are some of the models which we are working so when we started life, it was more all about storing data onto the cloud, making sure that I give the best customer experience. Now as we engage more with regulators, with especially from the customer side, InfoSec teams, we realize that we have also to evolve as infrastructure service providers. We can't just say that, put the data on the cloud, I'll take care of it, which we'll follow all the processes required, but if the customer feels that there's a better sense of or a better ownership of data that they have to protect, right? We have evolved models where data can continue to reside on the customer side and we just act as the gateways or the logic which enables them to give the better customer experience.
And on a lighter note, after the DPDP Act came, where the 250 crore fine was announced, we had certain partners earlier where they used to demand that this customer is mine, data is mine. Now they're telling, you are the data fiduciary, you keep the data, I don't want any data. So as Rakesh was telling, of course, the regulations and government always helps a lot in these areas.
But I wanted to ask, how is embedded finance developing in the full life cycle management, like repayments? Like when we were giving loans to drivers, my main thing was that unka jab bhi payment ho raha hai, to pehle mujhe milna chahiye. Right? So how is the repayments or collections or all of that working in this world of embedded finance?
So I think it's a model which will define whether the embedded is only from a sales cycle perspective or whether it also includes collections. So let's take an example. If somebody is going for a surgery, then it's a one-time exercise. He goes to the hospital, does a surgery, gets out of the hospital. Hospital doesn't have anything more to do with that customer for that particular procedure. Now, having a hospital involved into the collection side or anything is then really slows down your life cycle, means your entire sales cycle, your entire business motives, purely because then you are reducing your underwriting reliance and trying to push into the system saying that you should pay for it. No, but let's say, take another example where there is a 12-month hair program or the weight reduction program which is there. There you can work with the partner to create embedded journeys where you can create incentives for the partner to ensure that the customer keeps paying you back, and there you can then you can really build that program qualities as a part of the underwriting itself. But having said that, these are the as soon as we bring collections into this piece, unless it is a very, very strong data missing and etc., and you don't want to underwrite it, it is always better to just focus from the collection should be kept little away from the businesses side, purely because then the business, it will hamper the business growths from that perspective, because now there is an uncertainty you created in your merchant's mind. But if there's program needs where the merchant feels that he has, by giving this collection support, he can actually increase his sales, then I think it makes sense to do this piece. Like in your example of where the drivers are there, because the underlying problem statement was the attrition rate at the cab aggregators level, and they thought that it may be another way to improve it. But I think it really did not pan out really well out there. So that's why it is absolutely, and that's where the embedded finance is very fascinating. The underwriting, collections, the processes are very, very intertwined to each other. It's not a consumption loan. You gave the money based on the CIBIL plus 3-4 data points and ensure that over next 3 to 5 years the customer will keep paying his EMIs. Or a home loan where, in a way, home loan is also embedded nowadays. No, but if you look at the embedded, it is very, very differentiated underwriting at the merchant level, differentiated collections processes. You can collect a lot of data from the customer through the merchant, and that entire processes needs to be really, there is no one answer to fit everything. The collection can be a very, very big part of the embedded finance if it is dependent upon it, but only if the merchant feels it. Otherwise, if it's not a win-win for the merchant and for you, the merchant will, at some point in time, will go away from it. Yeah. So that's my...
I see it. Okay. So on the MSME side, till the product construct, okay, it's tri-party. Whether you're doing receivable financing, okay, payables part of it, right? Okay, the supplier gets paid, and then basically the anchor is going to pay. Right. So that's a beautiful product construct. See, if the construct is tri-party, your repayment problem is not there at all. Yeah. Actually, it's solved for. It's part of the product construct. Yeah. You come to consumer side, okay, it is more bilateral. The merchant is using his point of sale, to offer, okay, the embedded credit product which the lender is offering. In that place, the merchant wants to basically sell his whatever it is, his XYZ asset. Right? Afterwards, it is just between the lender and the consumer.
Yeah.
You see, so there is a trick is tri-party, okay, versus bi-party. The bi-party thing is not going to solve your repayment problem. I can give a beautiful journey. Okay, I can give a BNPL, I can do TNPL, I can do as many PLs, right? But we have to understand that the merchant's point of sale / platform / marketplace is getting used.
Yes.
Okay, so the consumer part of the embedded credit, okay, we just need to be more careful because the repayment is not totally embedded. Okay, can I have the mandate real time registered, okay, when Asim's time is, again, it adds a friction, right? It's the friction part of it. Of course, it can be done because you see now, okay, e-mandate and so many kind of mandates, it can be done. But then it is outside the product construct. It's a normal lending process. Okay, so the beauty of the embedded credit is tri-party, beautiful, right? Bi-party, be a bit careful.
I think Sumoth and Lavin, closing remarks for all of us, maybe if you can summarize, where do you see the future? You guys are seeing so many partners doing so many different things. Where do you see the future of embedded finance? And with that, we'll close the panel.
Just to add one point. Of course, right now on the retail side, we have seen almost all the developments happen almost. But maybe the next wave will be on the SME side and maybe new use cases like as like Ashish was telling about the hospital for the surgeries on the embedded payments or the educational payments. Maybe more and more such new fields can come where the finance can be embedded at the point of sale itself through the finance. Yep. So it's a lot more thing to evolve. But of course, we need to see how the DPDB also comes into play into the picture on the data side. Yeah.
So I started off with the introduction where I talked about separate rails, right? You had transaction rails, you had finance rails, and then there's a control rail, which is the reconciliation part, right? These all journeys at some point of time have to become continuous, right? You have more data points, you have more APIs coming into picture. Finance or credit is a confidence journey, right? More data points, more visibility, more workflows that we are able to give back to the lender. I believe this whole embedded finance journey will become more scalable, more visible, and that will unlock more areas. So I think we're going down that journey. Obviously, it's not perfect yet, but hopefully we'll get there.
Nice.
My last ticket is a Kirana store around the corner from my home. Okay, my 3 friends here, okay, they better deliver an embedded credit product to that. Because that's Bharat. Okay, and that's where basically the need of credit is there. So the challenge is tremendous, but let's solve it for Bharat, let's not solve it for India. It should not be a tier 1 product, it should be a rural product, okay, across anybody who can enjoy it, from our driver to that Kirana store.
Absolutely. Any other closing remarks? Otherwise...
So, I agree with you, Rakesh. It's a journey. Most of us starts with tier 1, then we go down because it's the entire business I always built incrementally. They never built directly. You go and build for the tier 1, then tier 2s, and then you build for Bharat. Unless you are building either bottoms up or you go top down. Just to give an example, you start with large hospitals, then you go to the especially hospitals, then you go to the small hospitals. It's a journey because at the end of the day, lending is a very clear business. You need to survive. The biggest thing, running the lending business is not giving money. It is just to survive the period of uncertainties, periods of crisis, and that's what we do. We don't really do lending or collection. We just do risk management, and that's where the entire game of lending is so beautiful. It's step by step, unlike a consumer internet company where you can go and build 10x, 100x. Here you get a call saying that you are going too fast. No.
Thank you everybody for a wonderful conversation.
Thank you so much for your time. I would now request our moderator, Sayali Karanjkar, Independent Director, Lenskart, to please give token of appreciation to the panelists in no particular order. Rakesh Bhatt, founder and CEO, Rahi Platform Technologies. Can we please give them a huge round of applause? Then we have Ashish Goyal, co-founder and whole-time director, FIBE. Then we have Lavin Kotian, co-founder and CTO, Transbank, transaction banking platform. Then we have Sumoth C, head fintech partnerships, Federal Bank. To give the token of appreciation, I would like to request Shashank sir to come up on the stage to felicitate our moderator who's moderated the entire panel so beautifully. Let's give it up for the moderator and the panelists, ladies and gentlemen. I would request all of you to please come ahead for a group photograph.